Welcome to our podcast on Accounting Standards Update number 2015-11, Simplifying the Measurement of Inventory. In this podcast, we'll go over the key elements of ASU 2015-11, including reasons for issuing the update and how the update is applied. My name is Todd Raven, and joining me in this podcast is Damon Romano. We are both senior managers in KPMG's Department of Professional Practice. Let's first start with why the FASB issued this update. In 2014, the FASB launched an initiative to simplify accounting standards through a series of short-term projects. These projects are intended to either improve or maintain the usefulness of the information presented to users of the financial statements while reducing the cost and complexity to financial reporting. As part of this initiative, in July of 2015, the FASB issued ASU 2015-11, Simplifying the Measurement of Inventory, to help reduce the cost and complexity of the subsequent accounting for inventory. Prior to ASU 2015-11, the FASB noted that there were many potential outcomes in applying the lower of cost or market measurement guidance in inventory.
Todd, can you briefly explain the guidance prior to this update?
Sure. Prior to the adoption of ASU 2015-11, companies were required to measure inventory using the lower of cost or market. Market could be the replacement cost, the net realizable value, or the net realizable value less an approximately normal profit margin. The assessment of market started with replacement costs, but an entity was required to compare this to the net realizable value, the ceiling, and the net realizable value less than approximately normal profit margin, the floor. Market did not exceed the ceiling nor fall below the floor. As a result, the board determined that this lower of cost or market was unnecessarily complex.
Thank you, Todd. What are the requirements under the new guidance?
Upon adoption of ASU 2015-11, entities who do not utilize last in, first out, or the retail inventory method will be required to compare the cost of inventory with the net realizable value and will not be subject to the ceiling and floor as before. Net realizable value is defined as the estimated selling prices in the ordinary course of business, less reasonably predictable costs of completion, disposal, and transportation. When entities determine the net realizable value is less than the inventory cost, the entity will recognize the difference as a loss in the period in which it occurs. It should be noted that entities with raw material inventory and work in process will still need to consider the cost to complete and sell finished goods when determining the net realizable value. Now that we have a background, Damon, maybe you can walk us through an example comparing the previous guidance with the new guidance.
Sure, I'd be happy to. We'll first walk through an example using the prior guidance and then walk through another example based on the same facts using ASU 2015-11. Let's assume a company uses the FIFO method, has finished goods inventory with a cost of $100. The net realizable value of this inventory is determined to be $105. The replacement cost of the inventory is $88, and the net realizable value less than approximate normal profit margin is $90. Under the prior guidance, the company would first compare the cost of $100 to the replacement cost of $88. Since the replacement cost is less than the original cost, the company would need to perform further analysis to determine the write-down. Next, the company would determine the ceiling, or the net realizable value. In this example, the net realizable value is $105, which is above the replacement cost of $88. In addition, the company would compare the replacement cost to the net realizable value less an approximate normal profit margin of $90. Since market cannot be less than the net realizable value less an approximate normal profit margin, or floor, market is determined to be $90. As a result, the company would recognize a loss in earnings of $10. Now let's assume the same facts as the prior slide, but apply the guidance in ASU 2015-11. As opposed to comparing cost to replacement cost, the company will compare the cost of $100 to the net realizable value of $105. Since the net realizable value exceeds the cost, no further analysis needs to be performed, and as a result, no loss is recognized into earnings during the current period.
Thank you. That is much simpler than before. So just to reiterate, companies that do not use the last in, first out, or the retail inventory method will now subsequently measure inventory using the lower of cost and net realizable value. The board excluded inventories accounted for using LIFO and retail inventory method from the scope of the new guidance because applying it to these inventories, in some cases, could result in significant transition costs and provide limited benefits due to the complexity inherent in those methods.
Todd, can you tell us about the effective date and transition?
Sure. The simplified subsequent measurement of inventory is effective for public business entities for fiscal years beginning after December 15, 2016, in interim periods within those fiscal years. For all other entities, it is effective for fiscal years beginning after December 15, 2016, in interim periods within fiscal years beginning after December 15, 2017. Early adoption is permitted. The ASU requires prospective adoption, and an entity is required to disclose the nature and reason for the change in accounting principle in the first interim and annual period of adoption. So with that, we'd like to thank you for joining this podcast today. We hope that the information provided gives you some insight on the simplifying the measurement of inventory. We would also like to inform you that you can find additional information on this ASU issued by the FASB through our Defining Issues publications on the Financial Reporting Network website, which is also where you can find additional podcasts and thought leadership publications on a host of other accounting topics.